Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. In this week's episode, we discuss the most debated topic of de-dollarization. Starting with why the dollar is dominant, we move to why the dominance is just diminishing but not completely disappearing anytime soon. We further present our ideas on how investors should play this theme. Let's start with the US dollar dominance itself. Thanks to a range of factors including the dominant size of the US economy, its sizable liquid and deep financial markets, convertibility of the US dollar itself, robust property protection rights in the US, prudent US macro policy, and the US banking system that has deep and wide international networks, the US dollar established its hegemony. As a result, over 80% of global FX transactions and more than 50% of global trades and payments happen in US dollars. Half of cross-border loans are in US dollar and more than 45% of international debt securities are issued in the greenback. In both trade invoicing and SWIFT payments, US dollar has more than 40% share of global markets. Further, circa 60% of official FX reserves are held in the US dollar. This extensive use of the US dollar compares with just under 12% share of US in world trade and its circa 25% weight in the global GDP. This very US dollar dominance is now being questioned increasingly as a few emerging market countries have voiced their opinion to de-dollarize their trade. There are a range of reasons behind the recent rise in de-dollarization talk. Push factors like deglobalization and weaponization of the US dollar are creating a necessity for countries to consider currencies other than the US dollar itself. Pull factors like the increasing availability of alternatives to US dollar and deepening bond markets in China may also be shifting the interest away from the greenback. More short-term factors like concerns around the banking crisis and debt ceiling issues in the US and positive interest rates in Europe after many years of negative rates are other attractions pulling the focus away from the US dollar. Also, to some extent, periods of cyclical weakness in the US dollar tend to feed the narrative of de-dollarization. For the context, broader US dollar has fallen circa 11% over the past 7 months. We think the concept of de-dollarization is being used in a very loose sense and without a strict definition. At this stage, we would think of this change in the US dollar usage under two scenarios: soft de-dollarization and hard de-dollarization. First, soft de-dollarization is the scenario under which countries adopt a diversified approach in managing their reserves. This scenario sees US dollar still being important, but with reduced dominance. The second scenario of hard de-dollarization sees the complete replacement of the US dollar as the reserve currency. On our assessment, we see a higher probability of a soft de-dollarization, which is consistent with our thesis of a rise of a multipolar world. To us, the chances of a hard de-dollarization are exceptionally low at the moment. After all, any complete change would need motives, but also means. We've already discussed the motives, but a hard de-dollarization lacks the means. That is, there are no credible alternatives for the US dollar yet. While euro, Japanese yen, Chinese yuan, Canadian dollar, Australian dollar, gold, and cryptocurrencies are all being considered as alternatives, to be fair, none of them have all the characteristics that US dollar has. This assessment sits nicely with our view that a hard de-dollarization has incredibly low probability in the near term. Also, we consider soft de-dollarization as a slow-moving and gradual but important risk that investors should keep in mind as they allocate for the long term. International investors should consider slowly diversifying their FX holdings across a broad range of strong alternatives. For multi-asset investors, gold might be worth considering, but sizing the yellow metal is particularly important to balance stability with opportunity costs. For equity investors, diversifying across companies transacting in other currencies vis-a-vis the US dollar may be prudent. For bond investors, striking a balance between hard currency and local currency debt may be worth considering looking ahead. As such, currency selection alongside country selection and security selection might be essential in the future. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.